So look, firstly, thanks for everyone for coming on today. You're all very welcome on today's webinar, which is going to be focused around retirement planning. We've done a lot of these kind of online financial webinars over the last year or so, and this is one that I kind of wanted to do for a while. And obviously it's really timely with the recent news in the last couple of days with this auto-enrollment pension scheme coming into place in Ireland. It's something that's been talked about for a long time now and constantly pushed down the road, but look, hopefully it is coming in place in 2024. I suppose coinciding with that, there was, I suppose, amendments to pension legislation last year, which changed how people, I suppose, take their benefits and access their retirement benefits. And even in the last kind of 10 to 20 years, the way people are taking their retirement benefits is very, very different to the kind of traditional way of doing things. So look, I think it's just going to be very beneficial for everyone to get kind of a fresh, I suppose, overview on the options that are available to you in leading up to retirement and obviously in retirement as well. For those of you who don't know, my own name is David Looney. I'm the Senior Financial Advisor in Alpha Wealth. And for those, just to give you a quick introduction to ourselves, Alpha Wealth are a financial planning company. We're headquartered in a place called Little Island in Cork, and we basically provide financial planning advice to individuals, families, business owners, and arrange financial planning consultations. So basically, as I said, give them advice in all areas of their personal finances. We currently have 8 advisors in Alpha Wealth, and we're happy to offer this financial planning consultation service to anyone who's on the call today at a reduced rate. I'm happy to talk a bit more about that at the end of the presentation, or if anyone wants to get in touch directly. We've a bit to get through today, so look, I'll just crack straight into things. If anybody does have any questions throughout the webinar as well, look, you can pop them into the chat, but I will be opening up some time at the end for questions as well. So look, just kind of looking at this overall concept of retirement planning, I think it is firstly important to maybe consider where our income is going to derive from in retirement when we maybe hang up our boots. I know my industry has a tendency to look at pensions as being the be all and end all of everything in terms of retirement planning, but there are many different sources where your income is possibly going to come from in retirement. Obviously, you have the state pension, which is about €13,000 per year, currently payable from 66. A lot of people will have private pensions alongside that, whether that's a personal arrangement or one in their occupation. Obviously, that is going to increase with this auto enrollment scheme, as I mentioned. I think this old view of retirement of people, hanging up their boots and retiring in the sun is a bit, outdated and not realistic as well. So I think a lot of people will probably look to work on in retirement, whether that's part-time, so you might be able to generate an income from that side. Obviously, people can generate income from other savings and investments and assets that they have built up, whether that's an investment property, providing passive income, whether it's the sale of a business that you're currently operating, or even just, cash in the bank or other investments. And then obviously we have things like inheritances and downsizing people's residence. But I think, it is important to focus on the things that we can control and the things that we can plan for, because look, arguably a lot of these things we can't exactly rely on. Certainly the state pension is, there is a risk in being over reliant on it. There's essentially not enough in the kitty to sustain the current level. So I think it's quite likely that the age at which people become in receipt of the state pension could be pushed out, or the benefit could be reduced. Obviously, I talk to a lot of clients and they say to me that they're going to, never retire and they're going to work to the grave. But, unfortunately, again, that's, not really realistic. You could have a deterioration in your health, and a lot of employers will pretty much push you out the door at 70 at the latest now. So again, that option might be there for people. So some of the areas that we can control now and put provisions in place around our, private pensions and building up other savings and investments. And that's really going to be the mainstay of today's presentation, I suppose. Firstly, I just want to talk about this concept of human capital, which I think is a really, I suppose, helpful concept to bear in mind when it comes to your overall financial planning or your retirement planning. because retirement planning is essentially replacing your human capital with financial capital as we get older and have to retire. Human capital is basically the present value of our future income streams, accounting for wage rises and inflation. So if you think of all your income payments or your salary payments that you're due to get over the next couple of years right up to retirement, it's the present day value of those, and it's really about, you know, using some of that human capital while it's there and allocating some money on a consistent basis to building up financial capital to replace your income in retirement. So for example, a 30-year-old earning 40,000 euro per year now after tax and working to 60 will have a human capital of 1.5 million euro now. Naturally, the human capital is going to reduce as time goes on, and ideally, as I said, we're trying to build up financial capital, which is kind of displayed by this image down below. So when it comes to gearing up for retirement, I do encourage people, particularly in their later years, to maximise the use of their pension. And I know pensions get a bit of a bad rap in our industry, and it is down to their complexity and their confusing nature, which is, look, I suppose, a criticism of the industry. But look, in simple terms, a pension is just a long-term savings plan, and it is the most effective way of saving money and reducing your tax in the process. I'm not sure why there's kind of yellow, I suppose, lines coming up on the screen, so apologies about that. But like the reasons for that, of course, is that for each €1,000 put to your pension, it only costs you €600 as a top rate taxpayer. So essentially you're paying 600, the government's paying 400, so you're getting €1,000 per month, or sorry, €1,000 into your pension for a net cost of 600. And the great thing is that each of those €1,000 are growing tax free. And so because of those reasons, it is, you know, the most effective way of saving money. And I would, you know, nearly just look at it as an alternative to sticking money into a bank savings account or a credit union account, but obviously with it being a very, very long-term view in mind. It really does not make sense using, you know, a standard savings account or an investment account for saving for your retirement, because firstly, you're taking the tax hit on your wages, you're putting after-tax income into those vehicles. There's not much interest to be earned, particularly at the moment on deposit. And even if you did earn interest, you're being taxed on that interest. So a pension does represent the best way of long-term savings. And people have quite generous scope to contribute to pensions, as you can see here. Generally, people under 30 years of age can put 15% of their income into a pension and get tax relief right up to that level, which increases to 40% of your income for those in the cohort of 60 or over. So, you know, while I don't believe everyone has scope to go right up to that level, I would be encouraging people to try to get as close to that as possible, particularly for people that are in the kind of 55 to 60-ish bracket, because, you know, there's no point taking a massive tax hit on all of your income now when you can shelter some of that income through a pension structure and just draw on it a couple of years later. So, you know, worthwhile bearing in mind if you have scope to. Just to reinforce that, I just wanted to, I suppose, kind of map out two different scenarios of a 55-year-old earning €60,000 per year and the influence that pension contributions will have on their overall financial situation. So the first one on the left-hand side is that person making no pension contributions. They're looking at take-home pay of €3,531 per month, but they're paying, you know, their fair share of tax, so they're losing €13,240 per year to income tax, which is €132,400 over the next 10 years, which is, you know, a hard pill to swallow. That person obviously is, you know, falling back on the state pension payable from 66 of €13,000 a year. And as I mentioned already, if they save or invest any money after their tax is taken out of their wages, they're also paying tax on the interest, usually of 33% or 41%. In stark contrast, if you look at the same person who's putting 20% of their earnings to a pension to age 65, they're coming out with €2,931 per month. So while they're giving up 7,200 of their take-home pay on an annual basis, they're getting €12,000 per year to their pension fund, which grows tax-free to their retirement. So, you know, you show me another investment where you give me €7,200 and it turns into €12,000 immediately, even before the money is invested. As I mentioned, there is the tax savings as well that comes with making pension contributions. So this person is saving €4,800 per year in income tax by making those contributions, which is €48,000 in income tax savings over the 10 years to retirement. versus the fella on the left-hand side. And if you're, I suppose, achieving an investment return on average of about 3% per year, which is quite modest and doable, you're working up a fund of 141,694 by age 65. You typically get to take 25% of that as a tax-free lump sum, which is 35,424 in this instance, and the remaining 106,000 can be drawn as regular income. So assuming you take 5% per year along with your state pension, you're coming out with €18,313 per year, in addition to your tax-free lump sum of 35,500. And people often ignore as well that your tax position in retirement or your later years is very, very different to your tax position now. So this person is actually only going to suffer an effective tax rate on that income of just 2.4% from 66. So you can see, you know, it is a much more favourable way of planning for your retirement, not only from a, you know, replacing income in a retirement perspective, but a tax reduction perspective as well. And I meet a lot of people in their, you know, late 50s or even early 60s, and they tell me it's too late for them to make pension contributions, and this, you know, just illustrates that is not the case. It is never too late to make a pension contribution. You can even do one right before you retire, and it makes sense for the tax reasons outlined here. As I just mentioned there as well, I think there is a misconception out there that pensions are just deferring tax. So, you know, some clients would say to me, look, that's great, I'm getting 40% relief on my contributions now, but surely when I draw on that pension, I'm paying income tax, so am I not just deferring the tax? And that is not the case at all, because people are ignoring the, I suppose, tax-free compounding growth that applies to a pension, which really adds kind of rocket fuel to your fund value if done right. They're ignoring the fact that you can take a tax-free lump sum from pensions up to a maximum of 200,000 tax-free. And they're also ignoring the fact that, as I said, some people's tax positions are much more favourable in retirement because the state pension is not subject to USC. You don't pay PRSI beyond 66, and you can earn more at standard rate tax. You know, this table just kind of illustrates it. And firstly, let me just say, the column that says income from state, this is basically you know, someone who is well before retirement age, but it's basically inflating the state pension to keep pace with inflation. So that's why it's saying a figure of 24,481, whereas in today's present value, it's more like 13,000. But if you just look at the pension fund row of 800,000, you're taking a tax-free lump sum from that guy of 25% of the fund, which is 200,000. You don't pay a cent of tax on that 200,000, so all of it is net of tax. And if you took 4% of the remaining 600,000, that's 24,000 euro per year, in addition to the 24,000 from the state, so that, you know, expected future value of it in this case. So this person is getting annual income of 48,500 nearly per year, and they're only paying an effective tax rate of 9% on that money, in addition to netting 200,000 as a tax-free lump sum. So again, you know, pensions are not just deferring tax. I appreciate there is a lot of you know, company directors or business owners on the call today as well, so your scope for contributing to pensions is a bit different, and that's why I just wanted to focus on that for a quick moment. If you are a company director approaching retirement and you have you know, significant cash balance in the company account, you really need to consider about, you know, how you're going to get your hands on that, or how you're going to get it out of the company account. And effectively you have, you know, three options regarding that money. One is to draw it out as salary, whereby if you're a top rate taxpayer already, you're going to lose more than 50% of that money to income tax, USC and PRSI. And the payment actually costs the company 11.05% in employer PRSI. So for taking 10 grand out of your company, it's costing the company 11,000 to pay you that, and you're losing 5 grand of that 10,000 to receive it into your hand. Option B is obviously to leave it in the company, where you're losing 12.5% of it to corporation tax. You're facing negative interest rates on corporate deposits, which has become the norm now, and you're possibly paying closed company surcharge. And of course, option C is to put some of that money into a pension fund for yourself, where the full amount derives into your pension and grows tax-free to your retirement. You don't suffer any income tax or benefit in kind in your hands, and there's no employer PRSI in the hands of the company. And the calculations for directors in terms of making contributions is a bit different to the table I showed up along with the age-related percentages. You've much more scope typically to fund pensions. So this example looks at a 60-year-old director who started a company 20 years ago and never funded a pension and wishing to retire at 65. So the company can make what are called ordinary contributions, which are kind of regular contributions going forward, but they can also make a special contribution for past service that was not funded. So in this instance, the company can actually contribute nearly €12,000 per month over the next 5 years to a pension, or €138,000 per year, or they can make a special contribution of €556,000 in addition to ordinary contributions of €26,904, or they can make a matching special and ordinary contribution of €115,194 each. So as I said, there is massive scope to extract money out of your company account in a very tax efficient way by using a pension structure. As I alluded to at the start of the presentation, the way people have taken are starting to take their retirement benefits has really changed over the last kind of 10 to 20 years. So it's important to know the options that are available to you when you go to draw on your retirement fund. The first element of it, of course, is looking at a lump sum. So typically you can take 25% of your fund as a tax-free lump sum. The first 200,000 of that is tax-free. The next 300,000 is taxed at 20%. So in simple terms, if you have a pension pot of 2 million, 25% of that is 500,000. You're actually netting 440,000 out of the first 500,000. So again, a really effective structure. So then the next element is the balance. So the 75% that's left in the fund after the taking the tax-free lump sum. As of last year, you now have two options. One is to transfer it to something called an approved retirement fund, or an ARF for short. And simply put, it's just leaving it within a pension structure. You can continue to invest it if you want, and you can draw down an annual income from the fund value to give you that income in retirement. And if you die, the ARF value is actually inherited by your estate. The other option for people is what's called an annuity, which was the kind of traditional way of drawing on pensions, but it's not as popular nowadays. And that is to purchase an annuity with a life assurance company, which provides you with guaranteed income for the rest of your life. You can also do a combination of both. And I just put a quick note up here again for anyone who's a company director, because you have a different option regarding the lump sum, which is to take a lump sum of 1.5 times your salary rather than 25%. So, you know, you'll get a lot of company owners might be maybe bumping up their salary in the couple of years before retirement as to get more tax-free out of their pension. But just be mindful that anything that is left in the pension after taking that lump sum has to go the annuity option at the moment, not the ARF option. So it is important, look, to maybe know the pros and cons of both options and see which is most appropriate for you in your own situation. Annuities is essentially you purchasing a regular income for life from the remaining fund value. The pros of that is obviously guaranteed income for life, no longevity risk, which is the risk of you kind of outliving your money. There's no investment risk involved because you're purchasing the annuity today at prevailing rates. You don't have to go investing that fund value. But the cons, of course, are, you know, they're arguably very poor value at the moment. People are obviously living a lot longer nowadays, and interest rates have significantly fallen, which means annuity rates have fallen. So, you know, people are getting a lot less income from their pensions, taking an annuity option than they would have previously. There's very little flexibility with an annuity as well, because the payments are set. It's not like you decide how much you want to take out per year, which is the case in the approved retirement fund. And one of the main downfalls, I think, for a lot of people when it comes to annuities is that there's generally no long-term capital preservation for your dependents if you die. And that really throws people off annuities. Whereas, as I mentioned earlier, if you die, your next of kin or your spouse generally inherits the value of your ARF. The table here shows some of the, you know, what would be some standard annuity rates in today's market. So if you look at the age 65, so a person who's retiring at age 65, it's, I suppose, encouraged that they would take an indexed annuity, which means that the payments would increase in line with inflation. So they're going to get an annuity rate roughly in the market today of about 3.9%. If they're looking to take a joint life annuity, you know, to provide a payment for their spouse if they die, they're looking at a rate of 2.8%. So these are, you know, quite low. And what that means in simple terms is that a single 65-year-old, for each €100,000 left in their pension fund after taking their lump sum, they're going to get guaranteed income of €3,900 per year. So the other option, as I mentioned, is the approved retirement fund, which has become kind of the preferred option nowadays. And as I said, it's simply just leaving 75% of the balance in the fund. You can continue to invest it if you want, and there's a whole host of different things you can do with it. You can even leave it in cash if you want, but I'll talk a bit more about that in a second. And you can draw down an income from the fund value. The pros of that, of course, are you can continue to invest funds to kind of preserve the fund or grow the fund. You've more flexibility, so you decide how much you're taking per year from the fund value. So for instance, if you're taking 5% of your ARF per year, you're already coming out with more than what the annuity option is giving you, assuming you can maintain that 5% per year. It allows for better tax efficiency, again, because you decide how much of it you're taking out as regular income. And the big one for a lot of people is that if they die, the value of the ARF is inherited. So particularly for people who might be in ill health in their retirement years or poor health, the ARF option might be more suitable because it has that element of capital preservation. The cons, of course, of an approved retirement fund is you do have to take on some investment risk really to kind of preserve your fund, which isn't very, very concerning for people if things are done right. And there is the risk, of course, of running out of money. I mean, if you're taking 20-25% of the value of your fund per year, it's not going to last very long. Now, when it comes up to retirement, you generally have two options or two channels to go down when it comes to transferring into an approved retirement fund. One is to move 75% of the fund after taking the lump sum to a life company, so like a Zurich or an Irish Life or an Aviva, and invest in some of the funds that are under their banners. And the other option is to move it to a self-administered approved retirement fund, which basically just puts the money in trust for yourself, and you've much more investment options. You can invest in the life company funds, you can buy direct shares on an exchange, you can buy direct property. So this is actually a really tax efficient way of owning an investment property in your later years. You can purchase a property through your ARF. Any of the rental income that the property produces is paid into the ARF tax-free because it's in a pension structure, and any capital appreciation in the value of that property is also tax-free because it's retained within a pension structure, and you can decide again how much of that you want to draw out as income for yourself. And so, really important thing to bear in mind when it comes to this investment conversation is that people are living a lot longer, and it's not unusual now for people to spend 20 to 30 years of their life in retirement. This table at the top just shows average mortality rates between the period of 2000 and 2017, and you can see that people are living a lot longer, which means that pension assets really do need to be partly invested throughout retirement in order to preserve income levels and keep pace with inflation, particularly as interest rates are 0%. This kind of risk and return scale on the bottom of the page is something we speak to clients every day of the week about. And people need to appreciate that everything they do with their money involves some degree of risk, but it's about managing that risk and taking the right level of risk relative to your, I suppose, situation and the time frame that you have. I suppose the old way of thinking, and a lot of people still think this is the way to do things, is that when you were in your early years, like your 30s or in your 20s, you'd be investing your pension in risk level 5 and risk level 6 funds. When you moved into your 40s, you'd pull it all back into a risk level 4, and then you'd pull it back into risk level 3 in your early 50s, and eventually by 60, 62, 65, you'd be pretty much 100% invested in cash, risk level 1 or no risk. That's really been flipped on its head, because as we said, more and more people now are going down the approved retirement fund option. They're spending 20 to 30 years of their life in retirement. So given that there's such a long time frame there, they're going to be remaining invested even throughout their retirement. So it's not, I suppose, uncommon or inappropriate now that even people in their late 50s, early 60s are invested in a risk level 4 or a medium risk fund, because the majority of their fund, being the 75%, is potentially going to be invested for kind of 20 to 30 years. And that's why, I suppose, more now than ever, it's important to get proper financial advice, even in your retirement years, to make sure that the balance between growing and preserving your fund, managing risk and maintaining the regular income from your fund is done right. So I suppose, thinking about why we should invest, and this goes to your pension savings as well as your savings outside of a pension, is, if you don't invest, you're stuck in cash, aren't you? You're stuck on deposits, which is, a terrible idea over a long period of time. For example, if we look at Michael here, who's 100,000 sitting in savings or maybe sitting in a cash fund, the big threat for him is that inflation is going to erode the value of his savings over a long period of time. So the impact of inflation on his money over a 15-year period, you can see just the examples in the blue. So I suppose traditionally an average inflation rate might have been 2 to 3% per year. At the moment we're seeing very high rates of inflation, more up into 5% per year. But even looking at rates of 2 to 3% per year, that really means you're losing purchasing power of more than 25 to 35% of your money over a 15-year period. So again, there's no such thing as taking no risk when it comes to saving or investing your money. Everything involves risk, and when you're talking about a very long period of time, it is important to invest in the market to make sure that your money keeps pace with inflation. And it is important, to appreciate some facts about equity markets. They rise and fall daily, weekly and monthly. It's part of the natural cycle of investing, but historically each significant market downturn has been followed by an eventual upswing. In any 10-year rolling period, the odds of global equities posting positive returns is 96%, and in any 10-year rolling period, multi-asset funds have never made a loss. We generally recommend that people do invest their pension assets, particularly in their later years, in multi-asset funds, just because they're a little less volatile than being exposed to the market as a whole. So I suppose sitting in cash is literally guaranteeing that your money is going to lose value. Being invested is a very, very little chance of losing money over the long term if you're well diversified, as you can see here. And again, there is a misconception out there as well that everyone's pension funds were wiped out in the 2008 financial crash. I even spoke to somebody yesterday who kind of mentioned this. And as you can see here, that's not really the case. If you were invested in the US stock market right before the 2008 financial crash and you remained invested for an 8-year period, you can see here if you started your investment in 2007, right before the 2008 financial crash, and held that investment to 2015, not only would your fund not have been wiped out, but the US stock market would have given a return of 42% or 4.5% per year over that 8-year period, despite one of the worst financial crashes we've seen happening within that 8-year period. Okay, so it's about being well positioned, well diversified, and keeping that long-term view in mind. So again, coming back to this time frame of 20 to 30 years in retirement, it does make sense to invest part of your money. Again, it is really important to get proper impartial advice and review your pensions when it does come to investment options, because there's umpteen options that you can select and many different providers, but there is a huge difference between what's on offer in the market today. So what I've done here is just compare 5 of the main risk level 4 funds in the Irish market over the last 5 years, all with different providers or life companies. So we have Zurich, Irish Life, New Ireland, Aviva and Standard Life. These are all similar risk level funds, so they're a medium risk fund. You can see here over the last 5 years, Zurich have returned nearly 40%. In stark contrast to that, you have Aviva here in the red, which has only done 18%, which is less than half the returns. Irish Life, just about over half the returns. New Ireland, 25%. Standard Life, a bit better at 26%. So it's about making sure that you are getting the very best on offer in the market. And I suppose one of the benefits of dealing with a company like Alpha Wealth is that we're not a tied agent for any of the providers in the market. We deal with absolutely all of them, so we can make sure that you are getting the best options for you. It's also important to make sure that you're not paying too high charges on any of your investment funds, either before retirement or after retirement, as they're just eating into your investment growth. It is possible for most people to transfer their pensions between providers. The exception there, of course, is if you're in a company-sponsored pension scheme, you generally are stuck with that pension provider while employed for that company, or it would make sense to stick with them anyway if you're getting a matching contribution from the company. But once you hit your retirement point, you can invest your approved retirement fund with any provider that you wish to. So it's about getting independent, proper advice around that. Something I get asked quite a lot, okay, is how much of a fund value should I have at retirement? And look, apologies, I know the slide is quite heavy. Firstly, I want to stress that it is case by case dependent, okay, but I find the sweet spot for our average client today is a fund value of about 600 to 800,000 euro at retirement. I am not saying that everyone on the call today needs to have a fund value of 600 to 800,000 at retirement, but what I am saying is that is the sweet spot, okay, and it is case by case dependent. The reason I say that is by, and firstly, you need to remember that this is to last you 20 to 30 years. So while that might seem like a massive sum of money, in reality, over such a long period, it's not. So the reason I say that is that a fund value of 800,000 will give you the maximum tax-free lump sum from a pension, which is 200,000. So by reaching that fund value, you're maximizing the amount of tax-free cash that you can generate from that pension. The lump sum can be used to, clear off any existing debt, set yourself up in retirement, maintain a rainy day fund, and set some aside for your family. If you have an 800,000 euro pot, you're putting 600,000 of that into an ARF. If you're going that option, drawing 5% per year gives 30,000 euro per year. The state pension is about 13,000 on top of that. So from 66, your total income in retirement is 46,000 a year. If you have a 600,000 euro pot, your remaining 450,000 is going to your ARF. Drawing 5% per year gives 22,500. And in addition to your state pension from 66, you're looking at income of 35,500 in retirement. It's important to bear in mind, okay, that those annual income figures will be discounted by inflation. So while they might seem very high, again, today's value of them is going to be a lot lower. And that is why I say those pension pots. Now, how can you accumulate a pension pot of 600,000, let's say? That's essentially average contributions of 356 euro per month of your net pay over 30 years, earning an average interest rate of 6% per year, which is very doable over such a period. That might seem very high, but what that essentially is 10% of a salary of 45,000. So if you're in a company-sponsored pension scheme, you're earning 45,000, you're between 30 and 35, and you're giving 5% of your gross pay per year, and the company is giving 5% per year, which a lot of schemes would run on. There's no reason why you shouldn't be able to hit a pension pot of 600,000. Again, bear in mind as well that income levels or salaries will naturally increase over time. So that's much more doable than the above figures might suggest. And as I mentioned already, a lot of people do get employer contributions, which is obviously going to come into light as well with this auto enrollment scheme in 2024. The situation is that the government is going to pay €1 for every €3 you contribute to a pension up to certain levels, and the employer will match your contribution up to certain levels. So I think by year kind of 3-4 of the scheme, after it's implemented, you will pay €3 per month. The company will match by €3 and the government will match it by 1. And you're still getting tax relief on your €3. So you're getting €7 going into your pension for the €3 that you're putting in. So really good scheme for those that don't have employer pension schemes in place already. Something I encourage everyone to do, is this thing that I call a health check on your financial future. And 4 things I insist you know regarding your pensions are: firstly, what the current values are; secondly, what level of contributions are going into your pension; 3, where those funds are invested; and 4, what income is your pensions projected to give you in retirement. By knowing early on, you can plan for your later years rather than going through your working lives blindly, not knowing what your pension is going to produce, and then finding out right before retirement that there's not enough in there. At least, figuring out if there's a deficit early on, it gives you time to, correct that. So I do appreciate that there might be some people on the call today that don't have scope to contribute to pensions, or might have limited scope to fund pensions. Maybe that's the case that you're taking a low level of income from your company, or maybe your income is coming from rental income from investment properties, for instance, which isn't pensionable because it's classed as an unearned income. So the 2 schemes that I want to talk about today, which is an alternative to a pension, is a savings investment plan and a scheme called the Employment Incentive Investment Scheme. So the first scheme I want to talk about is offered through Zurich, who are one of our preferred providers in the market, and it is really just a pension without all of the added tax benefits, and one that you can access at any point. So like a pension, you can pay into it on a monthly basis or as a lump sum. Like a pension, you can increase, decrease, stop and restart your contributions. Where it differs to a pension is that the money is not tied away to your 60 or 65 or 55 for company directors and stuff. You can access the money at any stage. You have the same investment options, and you should choose the same investment options based on your term to retirement and the investment term that you have. And like a pension, the risk level can be changed throughout it. A plan like this is ideal for building up kids' savings as well. For me, it is the best savings plan in the Irish market, and it is the all singing, all dancing alternative to sticking money into the bank, credit union or post office, as long as people have a time frame in mind of more than kind of 4 or 5 years. The second scheme, as I mentioned, is the Employment Investment Incentive Scheme, or EIAS for short. This is basically a revenue-backed scheme which allows you to invest a sum of money with a qualifying Irish company, and any amount of money that you invest with that company or company's revenue will kick you back a 40% tax rebate on the investment amount. And you also get a return from the company for the use of your money. It's becoming really popular as it's a really, I suppose, cheap and efficient way for companies to raise capital rather than going down the kind of private equity and venture capitalist route. The government are supporting it because it's obviously, promoting employment and economic growth. And the incentive for us is to reduce our tax and generate a decent return on investment. There's thousands of companies every year that will raise capital under the scheme. A lot of them are in the startup space, but there are some really, I suppose, established and progressive companies in there as well that have been around many years and have, revenue in the millions and some really strong clients. So it's about picking strong companies, but this just puts it in very simple terms. So an example of €10,000 EIS investment in 2022, what you'll get is next year in 2023, revenue will issue you with a 40% tax rebate on the investment amount. So you're getting €4,000 coming back to you, making the net cost of your investment just €6,000. And then in year 4, it's usually a 4-year scheme, 2025 in this case, you're getting your initial 10,000 returned plus an interest rate from the company, which is usually in the region of about 25 to 30%. So potentially you've €13,000 coming back to you in 4 years' time, all going well, in addition to your 4,000 coming back to you in year 1 in the form of the tax rebate. So the investment amount after tax relief, so the net cost of the investment in this case was just €6,000, and you're coming out with €13,000 all going well. So it's a double your money scheme if done right. And it is really important, as I said, to pick solid companies. We typically look around at all the companies that are raising capital under the scheme every year, and we'll cherry pick the kind of top 2 to 3 companies to recommend to our clients as an option under the scheme. So if anyone is interested in getting a bit more information on that, look, we're happy to offer it. This is really effective for, as I said, people that have non-pensionable income, whether that's rental income from investment properties or maybe withdrawals from your ARF if you're already in your retirement years. Focusing back on company directors or business owners, I just want to talk about 2 really valuable reliefs, just to be aware of if you don't already, which can be utilised alongside your pension for retirement planning and exit planning from your company. If people are exiting a company or winding up a company on retirement or disposing of business assets, they usually pay capital gains tax of 33%. But there is 2 very important reliefs to be aware of. The first one is entrepreneur relief, which basically reduces capital gains tax from 33% down to 10% on disposal of qualifying business assets. So, for example, if you are in your later years, you've €218,750 in your company bank account, and you wish to sell the business or liquidate the company and sell all your shares, the tax that you will pay on that cash balance is only €21,875, which is saving you 50 grand, more than 50 grand in tax, utilising that entrepreneur relief. Without the relief, you're paying a tax rate of, tax liability of 72,187. There is some terms and conditions that come with this, so just make sure that you're aware of it and planning early on if it is something that you're looking to avail of. The other one, which can also be taken in conjunction with entrepreneur relief and relief on pension contributions, is something called retirement relief. It has not even got to do with retiring really, but it is another relief against capital gains tax that applies to people that are between 55 and 66. So you can claim up to €750,000 per shareholder, or twice that for a couple that are operating a business at the time of selling or retiring their shares with the company. The limit for the relief is actually reduced to 500,000 for people that are 66 or over, so it's a bit more advantageous to do between 55 and 66. but marginal relief is applied for those who are over 66 and looking to avail of retirement relief. The example on the right hand side just kind of sets out what that might look like. So Paula, who's 67, so she's over 66, so her limit is capped at 500,000. She's selling shares in her company, which is a market value of 570,000. She can claim full relief because she's over 66 and the shares were sold for more than 500,000. So in Paula's case, her sale price of shares is 570,000. The first 500 of that is completely tax-free, and the excess at 70,000 is actually taxed at 50%. So she'll pay 35,000 euro tax, but the first 500,000 is tax-free. If Paula was to do the same thing at, say, 65, assuming she met the other criteria, all of the 570,000 would have been tax-free in that case. So look, that kind of, I suppose concludes everything today from a, retirement planning perspective, but there is many other areas that we can assist you with, such as savings and investments, protection and mortgage reviews, and pension and retirement planning, which we focused on today, and more specialist areas like estate and succession planning. So if anyone on the call is interested in arranging a financial plan consultation with us to, review all of the above, do please reach out. And as I mentioned, we're offering a